All right, welcome back to The Explainer. Today, we're digging into one of the biggest, most audacious accounting frauds in U.S. history. We're talking about the incredible rise and the even more spectacular fall of WorldCom.
So, at its absolute peak, you have to understand, WorldCom wasn't just some company. It was the titan of the telecom industry, a true Wall Street darling, with a market cap of over $115 billion. Just a massive, massive company.
And then, poof. On one single day in June 2002, the whole thing came crashing down. The company dropped an absolute bombshell. They admitted, get this, they had just made up $3.8 billion in profits. Not a miscalculation, just fabricated. You know, this stock was a cornerstone in so many people's retirement accounts, and it was halted after crashing down to just 9 cents. 9 cents a share. It effectively wiped out the life savings of thousands of employees literally overnight. So, yeah, let's get into how this happened.
Okay, so here's how we're going to break this down. We'll start with that sudden, shocking collapse. Then, we're going to rewind the clock and see how this tiny company became a giant. We'll look at the wild merger spree that powered its growth, and then we'll get into the nitty-gritty of how they cooked the books. After that, we'll see how the lie was finally uncovered and what we can all learn from this whole mess.
So, to really understand WorldCom, you got to go back to 1982. A massive court case broke up AT&T's monopoly on the phone business. For decades, they were the only game in town. Suddenly, the whole industry was thrown wide open. It was like the Wild West, a total free-for-all for new companies to jump in.
And stepping right into this new frontier was a guy named Bernie Ebbers. Now, he wasn't your typical CEO. He was a former gym coach, a motel owner, a real character with this folksy cowboy charm. He took over this small, struggling long-distance company, and with an absolutely ruthless focus on cutting cost, he managed to turn it profitable and fast.
But here's the thing. Ebbers figured something out pretty quick. The real way to grow, the fastest way, wasn't just selling more phone service. Nope. It was buying up other companies. And he had the perfect way to pay for it all. His own company stock, which was getting more and more valuable by the day.
And this right here, this is the playbook. It was a perpetual motion machine, really. First, you get your stock price way up. Then you use that inflated stock to buy a competitor. That acquisition makes it look like you're growing like crazy, so Wall Street cheers, which pushes your stock price even higher. And then you just rinse and repeat. It was genius, in a way.
And the peak of this whole strategy? Oh, it was their biggest, most audacious deal yet. In 1998, they bought MCI, the second largest long-distance company in the entire U.S., for an insane $37 billion. And they basically stole it right off from under British Telecom. This single deal turned Bernie Ebbers into an absolute Wall Street legend.
Right, but a machine like that can't run forever. When the dot-com bubble finally burst around the year 2000, that whole growth engine just stalled out. Suddenly, the acquisitions weren't happening. But the pressure to keep that stock price flying high, it was absolutely immense. And that pressure is what led them to commit a fraud that was, believe it or not, devastatingly simple.
Okay, so the whole fraud, at its heart, revolved around this one little accounting trick called capitalizing expenses. Sounds complicated, but it's not. Think about it like this. Let's say you rent a car for a month. That's an expense, right? It's a cost for that month. WorldCom's biggest cost was basically renting phone lines from other companies. It was a day-to-day operating expense. But what they did was they started pretending they were buying those phone lines, treating a regular everyday cost as if it were a long-term investment, like building a factory.
And this chart really just lays it all out, plain and simple. Look at the Honest Co. on the left. You make $100 in revenue, you have $50 in costs, so you report $50 in profit. Makes sense, right? Now look at WorldCom's magic on the right. Same $100 in revenue, same $50 in real cash costs. But their CFO, a guy named Scott Sullivan, he took 40 of those $50 in costs and just moved them over to the balance sheet. He called them assets, and boom. Just like that, their profit on paper magically jumps from $50 to $90. It was pure fiction.
So where were the watchdogs in all this? Well, their super prestigious auditor, Arthur Andersen. You might remember them from the Enron scandal. They missed it completely. The truth didn't come from Wall Street experts or the SEC. No, it was uncovered by a small and incredibly brave team of internal auditors, people working right there inside WorldCom.
And you can see here just how quickly this all unraveled. It was an intense few months. It all started in March 2002. The head of internal audit, Cynthia Cooper, Her team started noticing some really suspicious accounting. The CFO, Sullivan, he tried to stonewall her. But then in May, a tip came in about these bogus capital expenses. One of her auditors, Jane Morse, had to work late at night secretly digging into the accounting system to download the proof. And by June, they had it. They confirmed billions in fake entries and went straight to the board.
And you have to imagine the pressure Cynthia Cooper was under. I mean, the CFO of the company is telling her to back off. This was a move that could have absolutely destroyed her career. But she didn't stop. As she put it herself, it was a matter of right and wrong. Simple as that.
So once she presented her findings, the fallout was just immediate. And it was catastrophic. On July 21, 2002, WorldCom filed for bankruptcy. And it wasn't just any bankruptcy. At the time, it was the largest one in all of U.S. history.
You know, it's easy to just blame a couple of greedy executives. But the really crucial thing to understand here is that this wasn't just the work of one or two people. The entire system of checks and balances, it failed. The auditors, Arthur Andersen, who were supposed to be the watchdogs, they failed. The investment banks, who were just chasing huge deal fees, they failed. The rating agencies, who were literally being paid by WorldCom, a huge conflict of interest. And of course, the board of directors, which was packed with Eber's friends, they all failed to ask the tough questions.
So, what happened in the end? Well, for the guys at the top, there was a reckoning. CEO Bernie Ebbers got 25 years in prison. The CFO, Scott Sullivan, he cooperated, so he got 5 years. But what about everyone else? For the regular investors, for the thousands of employees who lost their life savings, there was no justice. Just total financial devastation. Over $114 billion of value gone.
So, if there's one big lesson to pull from this whole entire mess, it's this, and it's so important. Profit is an opinion. It can be massaged, it can be manipulated, it can be an outright lie. But cash is a fact. The actual money a company is bringing in or burning through, that tells you the real story. Always follow the cash.
And that leaves us with a really tough, critical question, doesn't it? When a company stock is just on a rocket ship to the moon and it feels like everyone is getting rich, the executives, the bankers, the investors, who is actually responsible for asking the hard questions? Who has the incentive, and maybe more importantly, who has the courage to stand up and say, wait a minute, does this actually make sense? It's a question that is just as important today as it was back then.